Hello, my name is Carissa DiRado, and today we're going to be joined with Chuck Hall, Director of Credit Services here at Premium Mortgage. Chuck, thanks so much for joining us.
Good morning. Thanks for having me.
Absolutely. So if you don't mind, I'd love to dive right in. Today's topic is all about credit score factors, and we know you are the expert on credit. So I'd love to have just a quick run through on the credit score factors, and then I'd love to hit you with a whole bunch of common questions that I get from borrowers as a mortgage loan officer.
Sure. So this is a kind of a real typical factor shot that you'll see if you go to a lot of websites or a lot of information sites about FICO scores or credit scores. So this is really accurate. And it's broken down by categories and obviously percentage-wise, which has the most impact. When we talk about payment history, which is 35%, that is really quite obvious. Is how do you pay your bills?
Right.
You have all sorts of different types of credit card, installment loan, gas cards that are on your credit report, and it's simply, are you paying in time?
May I ask a question here? Because this comes up quite commonly. I typically find that it won't actually get credit reported until you're over 30 days late. I know a lot of people are very touchy about like, oh, I paid it 3 days late. But when does it actually hit that mark on the credit report of a true 30 days late?
Sure, good question. Most credit grantors will not report somebody 30 days late, which would be a very derogative hit on your credit score
Yeah.
until you are past the 30 days from the payment that was due, the due date. So if a
Okay.
payment was due, say on the 5th day of the month, and you
Yeah.
make that payment maybe a couple days past that,
Okay.
they're not going to report that it's 30 days late until it's 30 days from that period of time. You
Okay.
probably will get hit with a late fee.
Of course. Okay.
Um, but I mean, the bottom line is still best practice is to pay uh, before that due date.
Yep.
And quite honestly, if you ever have trouble, if you're somebody who uses mail and you did not get that bill mailed out,
Mhm.
most creditors obviously all have online payment. And
Mhm.
I would always make it a priority to get that payment there on the day that it's due or before. But if you are a few days late, there is a buffer of essentially 30 days before they report it to the
Okay.
repositories where it will have a negative impact on your credit score.
Perfect. That makes sense. And I always encourage the individuals that I work with to actually use a check, like a checklist, rather than going based off from what's coming in the mail. Because it's just, you never know. Sometimes things don't get delivered.
Things don't get delivered, and quite honestly, the thing you have to be careful about too is credit grantors. Sometimes they all have different payment cycles.
Hmm.
So depending upon, whereas for example, an installment loan generally is very consistent. You know when it's due. Your either your
Yeah.
mortgage or your car payment. But credit card companies are funny, and they have different billing cycles. And I always look when I get a credit card bill as to how many days are in a cycle, when
Oh,
my due
okay.
dates are, because they occasionally change them. So
Okay.
if you're a creature of habit and you pay your
Yeah.
bills always the same, you want to watch it because sometimes it simply means you might have to get that out in the mail a couple days sooner if you're mailing it in.
Okay. That's a good point. Thank you.
Yeah. So the next category would be the amount owed. And really what we're talking about here is utilization. And
Okay.
so again, typically most people might have a car payment, you could have a mortgage or you'd have an installment loan, where you have a set
Okay.
payment, it's the same amount for a term, whether it be 2 years, 4 years, 30 years,
Okay.
depending, but
Yeah.
obviously revolving credit. And
Hmm.
what we talk about utilization is you have a credit limit, whether it be $3,000 or $300 or $5,000. The
Right.
utilization is really a key impact of how your FICO score credit scores are determined. And
Mhm.
generally speaking, um, um, it's a changing bar, but generally speaking, the best scenario is to keep things below 30%.
Okay.
That would be
And
the best rule of thumb. I would say 50% bare minimum, but the
Okay.
moment you get above 50% utilization, we'll say in your credit cards,
Yeah.
you start to have a negative impact on your scores. Doesn't mean you're going to drop, down, hundreds of points,
Okay.
but quite honestly, it's looking at a risk. The FICO score is saying
Yeah.
this person is getting near maxed out on their credit cards, and historically, people that do that end up making late payments. So
Okay.
that's why really what a FICO score too is, we should always mention really what a FICO score is,
Mhm.
is a risk score. And they're looking at the potential of somebody going delinquent. So
Okay.
FICO scores are really just telling creditors there's little risk or high risk. And
Okay.
sometimes that level of risk determines what type of interest rate you're going to get. So
Right.
it's always in your best interest to become a low risk a consumer.
Yeah.
And by keeping that utilization of your credit cards down at
Mhm.
bare minimum 50%, best case scenario, best is
Mhm.
30%.
Perfect. And this is actually where I see a lot of individuals who reach out to me asking about how to pop up the score. Usually I'll take a look and be like, well, utilization ratios are a little too high right now. Maybe we go through and get those paid down to that 30%. We'll probably see a nice increase in the score.
Yeah, and with that, on that same note,
Mhm.
people have you may have multiple credit cards, and each
Yeah.
credit card may have a different credit limit. So
Mhm.
when utilization is being figured, there are a couple different variables, but the reality of it is that it's the accumulation of all those credit limits you might have together
Okay.
versus what your current balances are. The one little kind of sneaky factor in there is
Mhm.
that the length of history, which actually is our next category,
Yeah.
um, which comes in at a 15% factor in your FICO score.
Mhm.
As you build history, the longer you have an account, a credit card, we'll say, for example,
Yeah.
and the more you pay your bills on time, that will also strengthen your score because
Mhm.
you've had a proven track record with that credit grantor that you've paid your bills on time. And
Yeah.
so the idea is that as you build your credit, you do want to keep credit cards you've had
Mhm.
open. And people are often asked, my score, does it get lowered if I close in a credit card? The
Yeah. Good
reality of it
question.
is it depends. I mean, the fact of the matter is if you're not using a card
Mhm.
and you still have it open, a
Yeah.
lot of credit grantors used just to leave it open. More and more days now, these days, credit grantors are reviewing their portfolios, and if someone
Yeah.
is not utilizing the account, they may basically tell you, if you don't use this in the next 60 days, we're going to close the account out. I
Makes
always
sense.
say, at the end of the day, get the credit that you need.
Okay.
But if you don't need it, and if it's something you're not going to utilize, there's nothing wrong with closing out an account or two. But the
Okay.
important thing, though, is it all depends upon um, how many other credit cards you have and how long you've had them. And if
Okay.
you end up closing out this account that you've had for a long time, and
Yeah.
meanwhile you only have a couple other credit cards that you've recently just opened up,
Okay.
closing out that older account could have a negative impact on your score.
Makes sense. Yeah, I always ask people leave the accounts open with a zero balance and just let the creditor close out as needed. And then if it isn't an account that they've had for a long time, that maybe should be the account they're actually using versus, trying not to open up new credit. So long-term relationships with creditors.
Well, there's also something, there's a term that was talking about,
Yeah.
should I keep, am I hurt by having a zero balance on a credit card?
Oh, okay.
Yeah,
Good question.
yeah. And again, we all aim to pay off our credit cards.
Right?
It's a great goal. And there's nothing wrong with doing that. But keep in mind, um, the way a FICO or most credit score models work, and we'll talk about maybe like a FICO score,
Yeah.
is that you actually have to have some type of balance in order to generate a FICO score. So if you were to say pay off all your accounts, owe
Mhm.
nothing, on one side of the coin, that's wonderful, and you should be rewarded for all those good practices.
Yay.
On the other
Yeah.
side of the coin, if you have no open balances and it goes out possibly longer than 6 months, you could very well end up not even having a credit score or a FICO score because
Yeah.
it's looking FICO score, they're looking at past history
Okay.
to predict future behavior. And
Right.
so, and they need somewhat current data. And so as much as the past history is important, having some type of small balance is also very important too. It's actually what they're saying is sometimes a little is better than nothing. And
Yeah.
so, but the real rule of thumb of that is simple. If you have literally just, you're trying to build credit, and you have a couple new credit cards, and they could even be a secured credit card, but they have very small balances. You often see somebody have 2 new credit cards, and because they've been told, open up some credit cards and build history, which is
Yeah.
great advice.
Okay.
And typically those credit cards you'll see might only be a $300 or $500 limit.
Okay.
So far, so good.
Yeah.
Where people get into trouble is they've got it. Next thing you know, it doesn't take a lot to get to the 75% or maxed out on those 2 small balance cards.
Right. Okay.
The rule of thumb there is you can immediately get point gains if you keep it below 50%.
Yep.
Or around 30. But quite honestly, if you only have a couple accounts like that, you actually can hurt yourself by paying down to 0.
Makes
That
sense.
scenario, you're better off to keep, a $10 or $20 balance.
Yeah.
It's a weird model out there, but it really benefits them to have a small balance when they really have no other type of credit on their credit report. For example, an installment loan.
Okay. And that actually makes sense too. And I know it happens quite a bit that I see where somebody uses a credit card but gets in the habit of paying it off in full each month. And I'm always throwing out and encouraging them just to keep that low utilization ratio, even if they are paying it off in full.
Well, we have some scoring tools that we
Yeah.
use to help our loan officers, and sometimes we're shocked when it comes back to help somebody with their score. Is coming back telling them to actually go spend $10 on a credit card.
Right.
And,
I know.
and again,
Seems weird.
the person's they've done the right thing. When people are trying to, who maybe have had some incidents in their life, whether they lost their job or medical situations, to where unfortunately they've had either some collections or medical collections or late payments and some things that have really negatively impacted their score. And they're trying to really climb back up that ladder, which is one thing I'll mention about credit scoring is it is redeeming, it is forgiving. And sometimes, the forgiveness is not immediate. It may take a plan. It may take 6 months, it may take a year. But ultimately speaking, if you kind of start taking these positive steps, the past history on your credit report, although if it's derogatory, although it's there, it does start to drop off. Because again, as I mentioned, FICO scores or credit scores are really looking at past behavior to predict future behavior.
Okay.
So if you kind of get, if you kind of those bad things that happen are in the rear view mirror in your car and you're driving further down the road, as you add more positive history and more positive experiences, your score can go up. And that's kind of the cool thing about this is you can go forward.
Gotcha. So as long as somebody reached out, put together an action plan, there is things that we can do and there's time frames that we can hit as long as somebody's willing to do the work and reach out.
Yeah, and that's a great point because at the end of the day, honesty is always the best policy, right. and sometimes there are not quick fixes, and people will sometimes reach out to credit clinics or other types of companies, and not all of them are bad, by the way. There are many legitimate credit counseling organizations that offer, particularly the nonprofit ones, that offer guidance and are maybe try to help to negotiate with some of the different creditors to try to come up with payment plans. Those are really, I think, they have a really good place in this industry. But sometimes there are other companies out there that will really, at the end of the day, what they're looking to do is get paid. Right. And there's a fee. They don't do it for free. And what they do is they typically will go out there and they'll look for cracks, or they'll go out there and try to dispute everything on someone's credit report. Yeah. And I always say, if something's wrong in your credit report, I mean, end of the day, you have to think of a credit report almost like going to the doctor. You should take care of your body. You should take care of your health.
Yeah.
getting a health check. You should also be getting credit checks,
Right.
especially in the world that we're in today, that everything that we go out there and buy, whether it be a home, which is just the biggest investment most of us make, or an
Right.
auto or student loans or whatever, all these things sometimes will cost us more money based upon what our credit is. And so the reality is that it pays, the better credit you have and better credit score you have, typically the lower interest rates you'll have, and in terms of the cost of money or borrowing money will be less. So it is really advisable to go out there and get a copy of your credit report, once a
Yeah.
year at least, or if not more than once a year. But when it comes to, and I'm getting at it, if there's something wrong with your credit report, you absolutely should dispute it. And let me be
Okay.
careful. When I say the word dispute,
Yes.
I mean investigate it. Go
Okay.
through the particular process, whether reaching out to the creditor or going through the 3 national credit repositories,
Yep.
Equifax, Experian, and TransUnion. They do have investigation or dispute processes. So if something is wrong, you should get it corrected. At the
Okay.
same point, if something is a legitimate debt and something that's there, just going out there and trying to dispute it is not maybe necessarily the best path. What some of the credit clinic type companies will do is they're
Yeah.
hoping that a creditor or a collection company will not respond.
Okay.
And if they don't respond, and they follow through the FCRA, the Fair Credit Reporting Act, and which is guided by the FTC in the industry, there's some specific guidelines that if a creditor is contacted through the process of the dispute process, the repositories, and they don't respond by a
Yeah.
certain period of time, they have to delete it off the credit report.
Okay.
So I guess my point on this is that I've always felt the best plan is to be a self-advocate or talk
Right.
to somebody, whether it be, there are many wonderful loan officers or other people in the industry who do know how to read credit reports and do know the best paths. It can guide borrowers, consumers to, I call it the self-help approach. There's nothing wrong with getting advice and talking to people. I've always just been leery of people paying for advice to how to help their credit report when there's so much free information and free sources out there.
No, that makes sense. And I was a credit counselor myself at a local non-for-profit for about 12 years. And then we did see a lot of these credit repair agencies that were going through and doing exactly what you had mentioned. They're disputing everything on the credit report. And as soon as the dispute was turned around, it goes right back on the credit report. So the credit repair company really didn't do anything. Versus if they were to talk to a local non-for-profit agency, the results are probably going to be a lot better. Or just kind of, as you'd mentioned, the do-it-yourself approach too. If there's something wrong, get it fixed. It's usually not too bad.
I would call, in particular, if you are a potential home buyer, and you are looking to get a pre-approved for a mortgage. One of the things I've had clients come back to me, and they'll have a borrower's credit report. And they'll say, and they have scores that maybe put them in a qualifying category, but meanwhile, they have several disputes on their credit report.
Yeah.
And not too many years ago, you could get away with that. But what's happened is all the different investors out there today, the Freddie Macs and Fannie Mae's and all these investors, they've gotten very smart. And the way their systems are, and again, it has to do with typically open accounts, recent accounts in the last couple of years that may have balances that have disputes on it. Well, their systems will basically not allow for that type of credit report to be used for a loan application, and it will reject it. So what will happen is suddenly the loan officer might have reached out to me and say, "Hey, we have to remove these disputes." And I said, "Okay, there's a process to do that. It is cumbersome. So we're trying to undo something that they paid somebody to tell them to do." So what happens is I call them faux scores. And essentially what it is that when you remove the disputes, we have some tools that certainly here at Premium Mortgage, you have access to that can take the disputes off in a simulated way to see if they're impacting the score. And so it's so often what happens is when those disputes are removed, the score unfortunately goes way back down. Because what happens is if that account is actually in some form of investigation, the repositories are required to put it in a status where it's not taken into consideration in the FICO score. So it's kind of taken out of the consideration. And so essentially, it's not really helping that consumer. It's a very temporary cosmetic look. At the end of the day, it's not really providing any gain. So,
exactly. And it takes a lot of work on my end to undo what has been done. So yeah.
Yeah, and the other thing on that I'll just mention too is you'll often see that done on collection accounts.
Yeah.
And ultimately speaking, collection accounts, and we talked about payment history earlier being the biggest category. How you pay your bills and how you pay on a regular basis and on time. We do know that accounts owed, collection accounts, are a severe derogatory item. And essentially, one thing I always will tell a borrower, whether it's a large bill with a utility company or a small medical bill, the number one thing that anybody should do if you're in a tough situation is to contact your creditors and communicate and try to talk to them. Because most of these companies, there might be some large banks who may not be that way, but most don't want to send it to collections.
Right.
Because at the end of the day, they end up losing money on it. And most of them are willing to work out an arrangement or figure out what they can do. And it's in their best interest to do this too. So the worst thing that you can do is ignore a bill that you owe, because unfortunately, if you do ignore it, it will eventually get sent to collections.
Yeah.
And it gets sent to the collection. It can just have a devastating impact on your credit score.
Absolutely.
And we're talking, 50 to 100 points. And it's so that is something I will stress. Communicate with your creditor or whoever it is you owe the money to, and be honest with them, and try to work on an arrangement and stick with it. And you can really save yourself some pain and also your credit score down the road.
That makes sense. And if you don't mind, this would be a great opportunity to lead into a question or an item that I see often is collections. And specifically older collections. I talk with a lot of folks, and older collections, they're trying to pay, and I'm discouraging it because it potentially could have a negative impact on the credit score, again, if the collection was paid. So I don't know if you could kind of make a couple comments.
So again, it's kind of the world of bizarro, because what we think that it would be best to pay those old collections. I mean, that would be the best intentions.
Right.
And unfortunately, that's not always the case, because if we're thinking about a credit report, so on a credit report, essentially, accounts stay in your credit reports as long as they're open. Creditors report on them essentially every month. If an account is no longer being reported or closed, it will drop off your credit report 7 years from the date of last activity or data being last reported. So if you have an older collection account, which basically an unpaid collection account is going to be on your credit report for 7 years. So it's on your credit report, it's owed, but now we're talking it's maybe 4 years old, 5 years old. It's not even being reported anymore. So typically, to your point, people are asked, well, should I want to pay those collection accounts will increase my score? The answer is, unfortunately, it generally will not increase your score. And it is essentially, sometimes it will actually hurt your score. And it will hurt your score because once that collection company gets your payment, they're going to redate it and update it as a new paid collection account. So two things have happened. If you've paid it off, great. Now it's going to look like a freshly paid collection account. And the date, the reporting date is going to be the current date. If you make a partial payment on that account, now what you've done also is bought yourself 7 more years of reporting on that account.
Right.
Now, in regards to new collection accounts, typically speaking, if you were to pay a collection account that's buying a report, we'll say generally a couple years old or less, it will not have any impact on your score. So we're talking about we're talking about accounts, by the way, that are with third-party collection companies.
Correct. Yes.
Versus a creditor. Versus a creditor that has you in a collection status. A creditor that has you in a collection status, that's regular reporting. Oftentimes you may actually see some type of small point gain by taking that out of a collection status with that creditor itself.
Okay.
But in regards to a collection company, generally paying a recent collection account will have no impact on you, good or bad.
Right.
It will show it's paid. And again, in regards to the mortgage process, most companies will require at some juncture those collection accounts, those current collection accounts, to be paid. My advice there is really listen to your loan officer and ask to what would be the best, what's being required for them in their process, and focus on that.
Yeah.
And again, most times to raise your credit score is not going to be focused on your collection accounts, but it's going to be focused on your utilization of your revolving credit.
Perfect. And that's exactly what I usually recommend. I won't have anybody pay collections unless the specific program that I'm putting them under is going to require that.
Yeah.
So just making sure it all comes together. I was also wondering if you could touch a little bit on that new credits, specifically when we're talking about mortgage inquiries as well too, and the time frame that somebody has for that inquiry.
Sure. So we'll talk about new credit.
Okay.
So essentially, new credit is, it's not a big factor. It's only 10%. And it can be something that can be pro or con, which is really typical of a lot of factors on your credit report. There are things that can be interpreted as good or bad. Some are very clear good, payment history, accounts owed. But with new credit there's nothing wrong with going out and applying for a new credit card. Now, if you feel as though that you want to get something, and it's something, it might be a benefit, maybe it's points, a travel card, or something like that. That's not considered a bad thing. At the same point, going out and applying for multiple credit cards or numerous types of new credit in a short period of time, that can be interpreted as something negative. So that can throw off some bells and alarms to a lender, saying, why is this person shopping for credit, or why are they trying to get multiple credit cards in a short period of time? And that's considered sometimes risk. At the same point, if somebody has really very little credit, and going out there and opening up a new credit card can be considered good. Now, to your question too, is inquiries. So everybody often asks about inquiries, and they're always concerned when anybody pulls their credit report. And you should be concerned, because you do not want your credit report pulled more than it needs to be pulled. But now, typically speaking, inquiries generally by themselves have little impact on a credit score. However, when you get multiple inquiries grouped together in a short period of time, and it really depends upon what type of inquiry. So back to the new credit, if you're going around the mall or online applying for credit, and you are getting a free gift at this store and a free gift at that store, by opening up a new credit card today, or getting 10% off, and they typically are revolving retail type, you'll see those in a short period of time, certainly, and those inquiries grouped together can lower a score. Now, when people are considering a mortgage, or even a car, for example, those types of inquiries are weighed very differently, because it's not unusual, and historically they know that it's not unusual that you can go and talk to maybe several different banks or several different mortgage companies, and in a short period of time you can get multiple mortgage inquiries. So what happens is most models factor all those inquiries as one inquiry within about a 45-day window. So they still are counted, and we're talking every one of these inquiries are hard inquiries. So a hard inquiry means it goes on your credit report. An inquiry that's on your credit report is a hard inquiry, stays on there for 2 years. And again, by themselves, they're not bad, but they're like a roadmap. And really, when another creditor pulls your credit report, they can see where you've been or who you've been talking to. But in regards to mortgage and auto inquiries, they themselves will show, but they really have very little impact by themselves on your score.
Especially when they're grouped together, right? Like within that 40-day, 45-day
when
window.
they're grouped together in that 45-day window.
Yeah.
But again, they do go in there.
Okay.
But again, the types of credit you apply for are differentiated by the type of inquiry.
That makes sense. Okay. And if you don't mind, I'd love to switch gears for a moment. Something that I see quite a bit is authorized users. And a question that I often get asked is, well, is there a way to get myself added on as an authorized user to somebody else's account as a way to boost my score?
Well, yeah, I mean, you do see that, and sometimes it's called, I mean, there's different terms. Some people call it piggybacking.
Yeah.
Yeah, probably one of the fastest ways of increasing your score is by getting added on as an authorized user. There are some different caveats that go along with that. For example, the user, I mean, the person who owns an account, obviously they're the ones making the payment.
Yeah.
So you want to make sure that person, is basically has good credit and is responsible. And typically it can be a spouse or may even be a parent. But the reality of it is, the owner of the account would have to request to their lender that this person be added. And they are. It typically takes 30+ days because they have to then report it to the repositories, the credit bureaus. And now what you're doing is you're gaining the history of that person, of how long they've had the account, how they're paying, the utilization. And so if somebody really has no credit at all, and one of the things is, a typical question is that somebody, for whatever reason, just has no credit history, and they are not being able to get involved by buying a home or a car or something because they need a credit score to qualify. So in general, if somebody has no credit, maybe it's a young person, and they get their first credit card, which is maybe a secured credit card, where the lender says, okay, you need to put down some money to guarantee it. At the end of the day, it takes 6 months of history being reported to generate that credit score.
Okay.
Now, if you're looking to speed that process up, getting added as an authorized user is one way of doing that.
Okay.
So,
and I do know some mortgage programs, if I see authorized user, sometimes I have to back it out. So I just want a little bit of caution with that too.
I would say the problem is simply that there are many lenders out there who will want that removed because they've understood that that's really not the history, and they're trying to measure the risk of that borrower, not the person who owns that account. And so you have to be very careful of that. The one thing I'll say about this, though, is an authorized user, if somebody has no credit and they're struggling to get a credit card, and maybe they want to go the secure route or they don't want to go the secure route, it's possible that being an authorized user can help somebody start their own credit too. And then eventually they can wean off the authorized user account. So there's a possibility, but you do have to be very careful about it today.
Agreed. Yeah, I definitely have seen that approach where they've been added on, then got the secured credit card, and then slowly back themselves out.
Well, in the worst case scenario, you've actually seen where the user essentially is maxed out in a card, or it's not unusual to see a credit report where people have credit, and for some reason they were added on as an authorized user in a card, and maybe it was at the very beginning of them building a credit file. But meanwhile, suddenly it will be determined where we're looking to help someone raise a score, and it will come right back out, is get removed as an authorized user, and usually has to do with utilization. But sometimes it's absolutely, people forget about it. It's like they got added on. It's like, okay, you can get me off now.
Right. Yeah, I do see that all the time. I'll go and show somebody their credit report, and they're like, I don't know what this is. And I was like, well, it's an authorized user for, your mom's account, and her utilization ratio is terrible. So let's get you off. Good. If you don't mind, I have a couple other screens. I just want to make sure we kind of hit on all the topics for today. So I know we talked about the utilization and the zero balance and the revolving, so I feel good there. We did talk about the history and also the new credit. We talked about the soft pull or the hard pulls and that. I did want to maybe touch on Credit Karma. A lot of individuals I talk to have a Credit Karma account. I personally, encourage it, have one myself, but I always look at it as a tool. It's free for a reason because they're selling your information, ads. But, if you could speak to the scoring models perhaps and why it's not
Sure.
exactly what it translates over to the mortgage industry.
Yep. So essentially, there are multiple companies that have been created over the last number of years to really give tools and access to consumers to really, I think, help themselves and better themselves. So I laud any of these companies, but to your point, they're all tools.
Yeah.
So, and Credit Karma is one of those, and they provide a service. Typically, you're giving them the okay to go maybe sell your name and contact information to other lenders. So as long as you don't mind being solicited by possibly other companies, that's fine. But they provide typically a 2-repository report. I believe it's TransUnion and Equifax.
I believe so.
And they utilize a model which is called the Vantage model. So we've been talking about models, and you've heard me mention FICO. I would say, just to clarify, Fair Isaac Company is a company that created the FICO model. They were really kind of the first model out there. They're typically what most lenders use out there today. There's multiple different versions of it. You've heard of FICO 8, FICO 9. The mortgage industry uses a very specific version of FICO, which is different than those, which could in turn explain why a loan officer may have a different FICO score than what a consumer may have if they get their own. The Vantage model, which was really created by the 3 repositories. So the 3 repositories created their own model, kind of as another option to FICO. I think they love the lending world out there to utilize the Vantage and not the FICO. But the reality is, scores are good, and scores are a sense of measurement. And whether it's a FICO model or a Vantage model, the reality is it's a measure. But what you have to be careful about is they are apples and oranges. And the reality is that we'll call it a Credit Karma score, which is really a Vantage score, typically scores 50 to 100 points higher than a FICO score. And, it weighs things differently. It weighs collection accounts differently. But in the sense of the data that it's returning on the credit report, the data is the data. And so if you are a consumer and you're essentially monitoring your credit report or wanting to see how things are updating, it's a wonderful tool. And just for example, the other sources out there, there's always the FTC approved site, which is the www.annualcreditreport.com. That's the site that every consumer or every person in America can get a free copy of the credit report once a year. One thing that they do in that site that's kind of interesting, and I'm sure Karma has these kind of same tools, but you can, once you get that credit report, you get essentially a consumer copy. And one of the most difficult things I hear people do is they have a hard time maneuvering, contacting the repositories.
Like the dispute process and that.
Absolutely. And so one of the things I'll always suggest is the best way to get into the door is to have a consumer copy of your credit report from the repositories, because they have their own unique file ID. And whether you do it online, which you can do a dispute on the consumer copy to the annual credit report site once you get the report back, or you can call. But if you do call the repositories, having that file ID or that consumer copy validates you've gone through the identity process. They want to make sure you are who you are, and there's not an issue with fraud. So then, ultimately speaking, you can actually talk to a real person. So that is something you can do. And And again, I just, one thing I see on this screen too is soft pulls. I did want to mention with that
Yeah.
is that we talked about hard pulls earlier when you go out there and apply for credit.
Mm-hmm.
Well, soft pulls are typically when you may get a pre-approval.
Okay.
You've been pre-approved for a credit card, or some type of, if you as a consumer get a copy of your own credit report, that's considered a soft pull.
Okay.
Soft pulls are only visible to you, the consumer.
Okay.
Other lenders who play your credit report can't see them.
Okay.
And soft pulls drop off your credit report in 6 months.
Okay.
And so the reality of it is you see more and more people today monitoring their credit reports.
Yeah, good.
And they will get notifications of when someone has pulled their credit report, whether it be a hard pull or a soft pull.
Yeah.
But and soft pulls have no impact
Okay.
on your credit score one way or the other.
So this might be when you're shopping around for your homeowner's insurance during the mortgage process.
True, and there are
Okay.
a lot of different parts of that process that soft pulls are used.
Okay.
But the actual true credit report that you use to be approved for a mortgage loan would be a traditional hard pull. But also in the process, they typically pull, sometimes called a soft pull or refresh credit report.
Yeah.
But typically late in the process, another credit report's pull to check for things such as new accounts, any new liabilities, and and again, another good habit is when you're going for any type of mortgage loan, this is a good time not to be applying for credit. It's a good time to be paying your bills on time, because these soft pulls that are done late in the mortgage process will give your lender an opportunity to view any of those. And not that all that is bad, but you'll just have to give an explanation of what those are.
Exactly. I've had this come up a few times, because right before we get official clear to close, the underwriter's doing that soft pull. I've actually had it in the past where somebody was a co-signer on somebody else's credit card and had a 30-day late right at the very end. And we were able to scoot around it, but it was
good
a
rule of
challenge.
thumb is don't be buying a new car at the same time you're getting a mortgage.
Exactly. And no furniture shopping or anything like that. Get permission from me before you do anything. Yeah. No, those are some good tips. And just going back to the annual credit report for just a moment, their dispute right through their online after you have your consumer report, they allow you to upload the documents and everything to really get the dispute process going. So that's one of my favorite ways to help coach somebody through that dispute process is that annual credit report and then doing the dispute right through that with the consumer.
Yeah, and I agree with that. And I've learned is, we have all different types of consumers out there. Some who are very PC savvy, and others that are not.
Okay.
And I believe the ability to do all that online is wonderful. And the other thing too with that is, as a consumer, once you actually, we'll say, initiate a dispute or an investigation at the repositories under the Fair Credit Reporting Act, once the repository has that, they will reach out to that creditor, and that creditor, once that communication goes to them, they have 30 days to respond back to the repository. Okay. So they either have to, resolve it, or if they don't believe the dispute's correct or whatever. But they have the ticker is on, and so that's why it's really effective to go through the process in a legitimate way, because you want to get the benefit of the law. FCRA in working with you, because ultimately speaking, one of the challenging things sometimes I've seen on credit reports, it's not so much now, but it was there for a while, but a lot of lenders, we were having a lot of banks being bought by other banks, and credit cards being bought by other credit card companies. So there would be data on a credit report where the lender that was reporting may not even be in existence anymore. And so that's why it's always a good idea, again, to take a look at your consumer credit report, make sure things are reporting accurately, up to date, and if there's something that's not correct on it, be proactive and reach out and try to get it taken care of, especially if you're looking to apply for a mortgage.
Perfect. I had a couple other questions for us. One of my first questions in regards to a credit freeze, because I do see this quite a bit when I'm going in, taking a look and getting a borrower pre-approved. I will see people with the credit freezes. So I didn't know if you could kind of touch on the freeze and then the unfreeze process, because that's usually a little bit more of a pain for us.
Sure. So, I mean, with the advent, particularly of all these data breaches that have happened
Yeah.
over the years and continue to happen, but again, the repositories, and there's other places you can do it, but I'll speak more to the repositories.
Okay.
They have all sorts of products that they provide consumers today. They'll sell many things. Sell you the ability to monitor your report, the ability to go buy your FICO score. But one of them is the ability to freeze your credit report.
Okay.
And we see more and more consumers freezing their credit report.
Yes.
Nothing wrong with that.
Yep.
But there comes a responsibility of it. And the responsibility is that if you are going to go out there and apply for credit, you have to unfreeze it.
Yeah.
And so freezing your credit report is a very simple process. You go online. I think there's a nominal fee you pay, and essentially most of them will create an account and a PIN for you. And so when you are going to go out and do any type of apply for any credit, particularly the mortgage process, which tends to be a longer process, and as we've already mentioned, you end up having a repull, a soft pull of your credit later down the process. You really want to lift the freeze on your credit report prior to working with your loan officer and going through the pre-approval process. Because at the end of the day, what will happen is they won't be able to get your credit report.
Yeah, that happens to me quite a bit. I'm like, oh, stop, we gotta have you go get it unfrozen.
Yeah, and honestly, it really should be a simple process. It can be done in a matter of minutes. I mean, but the hard part that I often see is that consumers sometimes forget that they froze their credit reports.
Yeah.
They forget their PIN numbers.
Yeah.
And if they forget their PIN numbers, the repository sometimes won't give it to them on the phone. They will mail it out to them. It delays the process. So it just, it's not that you can't resolve it. It just puts a delay on it. The other problem I've seen where someone has frozen their credit report, and when they're going through kind of the identity process to verify they are who they are before the repository, they maybe possibly have moved. And so what happens then is, again, now the repository may require them to provide some additional identification information that they'll put in the mail. So again, most people freeze their credit report, get it. They're very efficient at removing it, but there are times it causes some issues. But to unfreeze your credit report, particularly in the mortgage environment, you have the ability to unfreeze it for a specified period of time. It's good to do that. It's always very good to also lift the freeze globally. It's called a term called globally. That's very good. Sometimes they will come back and provide a borrower a PIN number. Well, for the mortgage process, a PIN number doesn't work. There might be a specific retail process may want a PIN number, but for the mortgage process, you need to lift it globally. But again, freezing credit reports, I think all of us today have received letters in the mail that we're potentially a victim of a data breach for some type of company we work with. I would say too, and one mention of that is someone will ask me, what's the difference between a credit freeze and a credit alert?
Oh, okay.
And a credit alert is where you think you may have been a victim of fraud. And quite honestly, you can go contact the repositories. And typically if you do, you can contact one or all three. There's short-term alerts and long-term alerts. The short-term alert is just basically stating that you've been a victim of some type of fraud, an alert. And it will, I think it's typically 90 days. And a long-term alert is where you actually put on there a contact number where you're asking that lender that you're applying for credit for to call you at that number to verify you are who you are.
Okay.
All good stuff. But again, I've seen where people sometimes have a new phone number, and next thing you know, the number they put out there. The one thing I'll mention about credit freezes, where they are very different than an alert, is a credit freeze will basically stop you from getting new credit. So essentially, it will any lender that you've who you've gone out there and you want to get credit, it will not allow for any new account to be opened until you open up.
Okay, that makes sense. And the last thing that I wanted to throw out there as far as my questions, or maybe even more of a statement than a question, but is the opt-out pre-screen. That is one of my favorite things. I've done it for life. I don't get any pre-approved offers in the mail. I don't have any of that, but I didn't know if you could kind of make a comment or two on that.
Sure. So I agree with you. www.optoutprescreen.com.
Yeah,
I think I've said it. If I had $5 every time I said it in my
I
life, it wouldn't be
know.
working. But no, it's a wonderful. It protects you in so many different ways. End of the day, your credit file is your data, but it's
Yeah.
really owned by the credit bureaus, and they sell your credit report to companies,
Mhm.
and they also sell your name and information to companies for leads or to sell products to. So if you want to cut down potentially on phone calls or cut down on potentially on getting junk mail,
Yeah.
optoutprescreen.com
Mhm.
basically will, for 5 years, will not allow any of the three repositories to sell your name to anybody. And that's really important in the mortgage process
Yeah.
because what's happened in this business is you're working, let's say, with you.
Yeah.
I'm working with you at Premium Mortgage.
Mhm.
And what would happen is that it's very possible through when you pull a credit report through something called a trigger lead,
Yep.
and no fault of anybody, but the repositories know because they got the inquiry,
Yeah.
they know that a credit report was pulled for mortgage purposes, for auto purposes.
Yeah.
They know where the credit reports are being pulled. And so they have these different divisions where they'll append the data. All they know is a credit report was pulled. There's no other data going back.
Okay.
But they'll append all other sorts of data because they have access to it, and they'll
Yeah.
sell those as leads.
Oh.
So what's very disconcerting sometimes will be that you've talked to a trusted loan officer
Yeah.
and speaking to them, and next thing you know, a few days later, you get a phone call from somebody across the country who's
Mhm.
trying to sell you a mortgage or ask you if you want to apply for a mortgage. And you say, how do these people get my name?
Yeah.
It's simply because your data was in the repositories. And if you go to optoutprescreen.com,
Mhm.
this will basically cut that off.
Yeah.
This will not allow for anybody out there to take your data or the repository to take your data and sell to anybody. So I'm a huge fan of it.
Yeah.
And I think it's something that it's more of a privacy issue.
Mhm.
And quite honestly, the repositories had to put this in place because the FTC, who
Mhm.
oversees the industry, basically, I think we're getting multitudes of complaints from consumers and borrowers and felt it was an invasion of privacy.
Yeah.
And so they required the three bureaus to put a tool out there that would allow you as a consumer
Mm.
to basically control who can see your data and who
I
can't.
like that.
So it's a
Yeah.
wonderful tool, and I do agree with you.
Mhm.
I'm a big fan of it.
Yeah, good, good. Well, I'm going to do the stop screen share here. So it's the two of us.
Perfect.
And really, as far as the questions go, I think I've answered, or you've answered all the questions that I typically will get on my end or a borrower will ask. Is there any other questions or common questions? There something else you wanted to throw out there before we end it?
I would say the one thing we talked about a little bit though, but what I'm a huge advocate for
Uh-huh.
is for borrowers, consumers to learn more about their credit,
Yeah.
understand what they can do to self-help themselves,
Yeah.
but also don't be afraid to ask other people who have knowledge. There's so much information out there
Yeah.
on the internet. Again, I think that there's nothing wrong with utilizing any of these free sites of getting data,
Okay.
but just also be careful that and not get confused that different lenders use different models,
Yeah.
and just understand that the best policy is to pay your bills on time,
Mhm.
apply for credit as needed,
Okay.
and really try to just have good credit habits. And if you
Yeah.
do that, a good credit score will follow.
Perfect. I love it. Well, I really appreciate your time today. I think the information you provided is such a wonderful tool and a resource for the individuals out there who are either getting ready to apply for a mortgage down the road or in the process right now. So I think this was wonderful. Thank you for
Well,
your
thanks for
time.
inviting me. I really enjoyed it,
Yeah, I
and
appreciate it. And we love
good
having you
luck.
here at Premium.
Thank you.
Yeah, have a great day. We'll talk to
You
you.
too. Bye-bye.
Bye.